Welcome to the Income Tax webinar for government employees and their spouse or common law partners who are posted abroad. I'm Marie, your host for this webinar. So the topics that we'll cover today are residency for tax purposes, tax obligations, change of use of your principal residence, rental income, foreign income, investments, income splitting, and credits and benefits. You can send in your questions at any time before the live presentation is finished. Over the next 24 hours, we will try to answer as many of the questions that we were not able to answer during the live presentation. The questions and the answers will be posted on the webinar page for the next 5 days. For the purpose of this webinar, please note that when we say spouse, we are referring to both a spouse or a common law partner. So let's start off with section 1 about residency for tax purposes. Canada's tax system is based on residency, not citizenship. It is therefore imperative to determine your resident status in order to determine your tax liability in Canada. Although the Income Tax Act does not contain a definition for the term resident, subsection 250(1) deems certain individuals to be resident in Canada, and subsection 250(3) states that a reference to a person resident in Canada includes a person who was, at the relevant time, ordinarily resident in Canada. Canada's tax system uses the principle of self-assessment. It is therefore your responsibility to determine your residency status. The CRA will provide a determination of residency status when asked. The courts have qualified residence to mean the degree to which a person in mind and fact settles into or maintain or centralizes his ordinary mode of living with his accessories in social relations, interests, and conveniences at or in the place in question. Residence is therefore much more than a person's home and considers several factors that influence an individual's ordinary mode of living. Some of these factors can include degrees of time, objectives, or intentions for being there and the continuity of a person's life in the location. Residence in a location is contrasted with sojourning in a location. So what does that mean? Residency in the place where a person has personal, social, and economic interests. It is also where a person normally participates in many other aspects of society. The personal, social, and economic aspect of a person's life are referred to as residential ties. When determining your residency status in Canada for income tax purposes, it is important to consider whether or not you maintain or establish residential ties with Canada and abroad. Significant residential ties to Canada, also known as primary ties, includes a home, a spouse, or dependents. Secondary residential ties are also considered, and they can include personal property, such as a car or furniture, social ties, such as membership in Canadian recreational or religious organization, economic ties, such as Canadian bank accounts or credit cards, a Canadian driver's license, a Canadian passport, or health insurance with a Canadian province or territory. The residential ties you establish or maintain in the other country are also relevant and are considered. The residency status of an individual who leaves Canada is determined on a case-by-case basis. An individual may be a factual resident, a deemed non-resident, or a non-resident. If an individual becomes a non-resident during the year, then they would be a part-year resident and are considered to have emigrated from Canada. On the other hand, if the individual becomes a resident during the year, they are considered to have immigrated to Canada for tax purposes. This applies to both newcomers and returning residents. An individual who is ordinarily resident in Canada is considered to be factually resident in Canada. The term factual resident means that although they left Canada, they are still considered to be a resident for Canada for income tax purposes. You may be considered a factual resident of Canada if you have maintained significant residential ties and are either working temporarily outside of Canada, teaching or attending school in another country, commuting from Canada to your place of work in the United States, vacationing outside of Canada, or if you spend part of the year in the US, for example, for health reasons. Where an individual is deemed not to be factually resident in Canada, that individual may still be deemed to be resident in Canada for tax purposes, by virtue of subsection 250(1) of the Income Tax Act. If you are deemed resident of Canada for tax purposes, if you lived outside of Canada during the year, you did not have significant residential ties, and you were in one of the situations. So either a government employee, a member of the Canadian Forces, including the overseas school staff, or working under a Canadian International Development Agency assistance program. So if you're in one of these situations before your appointment abroad and do not ordinarily reside in Canada, then you would be deemed resident of Canada. A non-resident is an individual who is absent from Canada for an extended or undetermined period of time and who has severed their significant residential ties. A deemed non-resident is otherwise resident of Canada, but is resident elsewhere under an international tax agreement or treaty. For example, if you're a factual or deemed resident of Canada, but the tax treaty between Canada and the other country determined that you are a resident of the other country, you would be deemed non-resident in Canada for tax purposes. The residency of the spouse of a servant of Canada is determined on a case-by-case basis. Generally, the spouse is considered either a factual resident or a non-resident. A general rule is that if both spouses have the same residential ties and the government employee is a deemed resident, then generally the spouse is a non-resident. Or if the government employee is a factual resident, then generally the spouse is a factual resident. So when is the spouse of a government employee a deemed resident? Under paragraph 250(1)(g) of the Income Tax Act, the spouse is a deemed resident if, under an agreement or a convention between Canada and the other country, the spouse is entitled to an exemption of income tax, and the exemption applies to all or substantially all of the spouse's income from all sources. So in other words, 90% or more. And the spouse is entitled to the exemption because of their relationship with a government employee who is a resident of Canada. An example is the Vienna Convention. The convention does not cover the spouse of employees of the Canadian Armed Forces. If you're submitting a request for a determination of residency status, so Form NR73, Determination of Residency Status Leaving Canada, and the spouse meets the condition under paragraph 250(1)(g), then answer yes to the following question on the form. Will you be exempt from taxes in the foreign country because of your relationship to your spouse? If you are the spouse of a Canadian government employee and are moving with your spouse and family to another country for your spouse to carry out a foreign assignment for the government in Canada, and it is your intention to return to Canada following the assignment, then you will be considered a factual resident of Canada. This factual residency is based on your intention to return to Canada, as well as your secondary residential ties maintained with Canada. In this case, do not complete Form NR73. If you believe that you will be a non-resident of Canada when you leave with your spouse and family for the foreign assignment because your intention, primary ties, and secondary ties support your status as a non-resident of Canada, then you should complete Form NR73. The CRA will provide the information in your completed form to determine whether or not you'll be considered a non-resident of Canada. A factual resident of Canada is also a resident of a province or territory of Canada. Generally, it is a province or territory where you resided prior to your departure and where your residential ties are closest. Sending up a post office box in another province or territory prior to your departure does not in itself make you a resident of that province or territory. So here are some references for more information on residency for tax purposes. These references are also included in a links document provided at the bottom of the webinar page. So we'll be breaking for a minute so that you can submit your questions or take note on the information we just presented. I'll be back shortly. Let's continue with Section 2 and talk about tax obligations. Both factual and deemed residents are taxed on worldwide income, that is Canadian sourced and foreign sourced income. Also, they are eligible for federal credits and deductions as they would be if they were resident. If you're completing a provincial or territorial form with your return and you are a factual resident of Canada, complete Schedule D and attach it to your return. A non-resident is taxed on Canadian source income only. In the case of a part-year resident, that individual is taxed on income from all sources during the resident period and from Canadian sources during the non-resident period. The way in which income is taxed may also differ depending on the type of income. Certain Canadian source income that is paid to a non-resident is taxed at source, or automatically withheld from the payment, at the correct rate of tax. As a result, that income does not need to be reported on a Canadian income tax return. We will go further into this topic later in the presentation. Although factual and deemed residents are both subject to tax on their worldwide income, the way in which they are taxed is slightly different. Whereas a factual resident is provincially or territorially taxed, a deemed resident pays a federal surtax instead of provincial or territorial tax. The federal surtax is 48% of the basic federal tax. If you're a deemed resident on December 31st, use the income tax package for non-residents and deemed residents. Generally, you are posted abroad for longer than 1 year. In the year you leave, you are deemed resident for the entire year. In the year you return, use a tax package for the province or territory where you are living on December 31st. Certain individuals who would normally be subject to the federal surtax are also subject to Quebec provincial tax. These individuals are required to file a federal income tax return and a Quebec provincial income tax return. Double taxation results when certain non-residents and deemed residents, because of the Quebec Income Tax Act, are liable to tax to the province of Quebec. The Federal Quebec Remission Order exists to provide relief from the federal non-resident surtax, for example, on certain income that arises in the province of Quebec. Similarly, a Quebec Provincial Remission Order is granted by the province of Quebec to provide relief from provincial tax to deemed residents, for example, who are members of the Canadian Forces. So contact Revenue Quebec if you have questions about your residency status in the province of Quebec. In most cases, the due date for a return is April 30th of the year following the year in which the income is earned. However, there are some exceptions, but in all cases, payment is due on April 30th. If you're in one of the following situations, you must send your return by mail. So if you're considered a deemed resident of Canada, if you're an immigrant or non-resident of Canada, or if your address is outside of Canada. If you're in one of those situations, please mail your return to the International and Ottawa Tax Services Office. So here are some references for more information on tax obligations. These references are also included in the links document provided at the bottom of the webinar page. We will be breaking for about a minute so you can take the time to submit your questions or take notes on the information we just presented. I'll be back shortly. Alright, so let's move on with Section 3. Change of use of your principal residence. So if you choose to rent out your home while away, please note that when you change the use of your principal residence from personal use to income producing, you are deemed to have disposed of your property and immediately reacquire it at its fair market value. You must report a capital gain on your tax return in the year the change of use occurred. In Canada, the capital gain earned during the period that your property was your principal resident is exempt from tax. You generally cannot claim a principal resident exemption for the period that you were non-resident of Canada. If, when you return, you change the use of your property from income producing to personal use, you are again deemed to have disposed of your property at fair market value and reacquire it. You must report the capital gain you earn on your return for the year in which the change of use occurred. Under certain conditions, an individual may elect under subsection 45(2) to treat the property as if the change of use never occurred. This election must be presented in writing with the return for the year in which the change of use occurs. The CRA may accept a late, amended, or revoked election under the taxpayer relief provisions. However, you may be charged a penalty. For more information regarding the taxpayer relief provision, you may consult the Information Circular IC07, Taxpayer Relief Provisions. So here are some references for more information on change of use of your principal residence. These references are also included in the links document provided at the bottom of the webinar page. So now let's move on and talk about rental income. Income is included in the general income tax. Factual and deemed residents must report rental income in their return. Use Form T776, Statement of Real Estate Rentals, to list and deduct your reasonable expenses incurred to earn rental income. Since the building, furniture, or equipment used in your rental operation is considered depreciable property and wears out over time, you can deduct its cost from your rental income over a period of several years. This deduction is called capital cost allowance. You may deduct current expenses from your gross rental income in the year that you incur them. It is important to note that the difference between a current expense and a capital expense. A current expense is one that generally reoccurs after a short period, such as the cost of painting the exterior of a wooden property. A capital expense generally gives a lasting benefit or advantage, such as the cost of putting vinyl siding on the exterior walls of a wooden property. If you're a non-resident and you receive rental income, you must obtain an agent. An agent can be any person or property management company resident in Canada. Your agent must have a non-resident withholding account with the CRA. If the person who you choose does not have one, they may call us to create one. A non-resident of Canada who receives rental income from Canada is subject to a 25% non-resident withholding tax, also known as Part 13 tax, on the monthly gross rental income. This amount is withheld and paid to the taxpayer's agent's non-resident withholding account and is the taxpayer's final obligation to Canada on that income. The taxpayer's agent is required to provide to the taxpayer Form NR4, Statement of Amounts Paid or Credited to Non-Residents of Canada, showing the gross rental income received in the year and the amount of tax credited to the agent's non-resident withholding account. The non-resident taxpayer may elect to file a tax return under Section 216 of the Income Tax Act. It may be possible to withhold 25% on the net rental income by completing the Form NR6, undertaking to file an income tax return by a non-resident receiving rent from real or removable property or receiving a timber royalty. If approved, then there is a requirement to file a return. For more information on that topic, please consult the guide T4144, Income Tax Guide for Electing under Section 216. If you emigrate from Canada in a year, you're considered to be a part-year resident. That is, you are resident for the period prior to and including your departure date, and non-resident after your departure date. The rental income that is earned during the non-resident period is subject to Part 13 non-resident withholding tax. If the fair market value of all the property you own when you left Canada was more than $25,000, complete Form T1161, List of Properties by an Immigrant of Canada, to list all of your properties inside and outside Canada and attach it to your return for the year of emigration. However, certain properties are excluded from this calculation and should not be included in the list. For more information and a list of properties excluded from this calculation, see Form T1161. The penalty for failing to file Form T-1161 by their due date is $25 per day you are late. There is a minimum penalty of $100 and a maximum penalty of $2,500. So please note that even if you do not have to file a return, but the Form T-1161 is still required, you must send it on or before your filing due date. So here are some references for more information on rental income. These references are also included in the links document provided at the bottom of the webinar page. So we'll be taking another little break so you can take the time to submit your questions or take note on the information we just presented. I'll be back shortly. So let's move on and talk about foreign income. As a resident of Canada, you must report foreign income on your return. Generally, the foreign country has a right to tax income which arises from that country. If there is a tax treaty between Canada and the country from which the income arises, the foreign country may be limited to the amount of tax it may charge on that income, or the income may be exempt from tax in Canada. In any case, the foreign income must be reported on a Canadian tax return, and the appropriate credit or deduction may be claimed, if applicable. If you paid tax to a foreign government on that income, you may be eligible for a foreign tax credit. A foreign tax credit reduces your federal and provincial or territorial taxes payable to a maximum of 0 on the corresponding foreign income, if applicable. If the foreign country taxed the income at an amount exceeding that which is permitted by the treaty, you must seek a refund of the overcharged amount from that country. The calculation of the foreign tax credit will be based on the amount that is permitted by the treaty. In order to claim a foreign tax credit, you must provide proof of foreign taxes paid. If the foreign country has a tax year that does not correspond to the Canadian tax year, or you are unable to obtain proof of the foreign taxes paid by the due date of your Canadian tax return, do not claim the foreign tax credit. You can request an adjustment to your return once you have the proof that you have paid the foreign tax. So here again some references for more information on foreign income. These references are also included in the links document provided at the bottom of the webinar page. So let's carry on and talk about investments. So factual and deemed residents may contribute to a tax-free savings account under the same rule as a resident. It is very important to note that non-resident may not contribute to a TFSA. There is a penalty tax of 1% of the non-resident contribution for every full month those contributions remain in the TFSA. If you have contributed to the TFSA during the non-resident period, withdraw the amount corresponding to the non-resident contribution to stop the monthly 1% penalty tax. If you contribute or wish to contribute to a registered retirement savings plan, note that residency does not restrict you from making contribution. In all cases, you must have the appropriate deduction limit in order to contribute. However, please note that certain financial institutions may prohibit the purchase of RRSPs by non-residents. Earned income for the purpose of calculating your RRSP's deduction limit include employment income, foreign income, CPP, QPP benefits, rental income, and business income. If you emigrate from Canada and have a balance remaining under a home buyer's plan or a lifelong learning plan, you must repay the balance or include the balance as RRSP income on your return. It is your responsibility to inform all payers of your residency status. Certain types of Canadian income earned by non-resident is subject to a 25% Part 13 non-resident withholding tax, or, if applicable, at the rate that is limited by a tax treaty between Canada and the country of residence. This withholding tax represents a non-resident's final obligation to Canada on that income. The payer will issue Form NR4, Statement of Amounts Paid or Credited to Non-Resident of Canada, which will indicate the gross income and the amount of tax paid on that income. If the taxpayer is informed proactively of a non-resident status, then the correct amount of the non-resident withholding tax should be withheld by the payer at source. Part 13 withholding tax applies to most forms and passive income, such as dividends, pension income, RRSP income, and employment insurance. If your spouse is receiving employment insurance and is a non-resident, it is very important that they inform EI of their non-resident status. If your spouse is a per-year resident, then the employment insurance that is earned during the resident period is reported on a Canadian return. The employment insurance that is earned during the non-resident period will be taxed at source at the correct rate. Income that is taxed under Part 13 is not reported on a Canadian return unless electing under Section 217 of the Income Tax Act. So for more information regarding a Section 217 return, please see Guide T4145, Electing under Section 217 of the Income Tax Act. So again, here are some references for more information on investments. These references are also included in the links document provided at the bottom of the webinar page. So we'll be breaking for a minute so you can take the time to submit your questions or take note on the information we just presented. I'll be back shortly. So let's carry on with Section 7 and talk about income splitting. Under Canada's tax system, federal personal income tax rate increases with the level of taxable income of the individual. As a result, a couple in which one individual has a higher taxable income than the other often pays more federal income tax than a couple where both individuals have equal taxable income. The family tax cut is a non-refundable tax credit of up to $2,000 for eligible couples with minor children. The calculation is based on the net reduction of federal tax that would be realized if an individual's taxable income was transferred to their eligible spouse. The maximum amount of taxable income that can be transferred is $50,000. This would take advantage of a spouse's lower income tax bracket. It is important to note for families that are posted abroad that both individuals must be resident of Canada on December 31st of the tax year. If your spouse is a non-resident on December 31st of the tax year, you will not be able to split your income under the family tax cut. So there are restrictions that prevent an individual from claiming the family tax cut credit. You cannot claim this credit if you're confined to a prison or similar institution for a period of 90 days or more during the year, or your spouse is claiming the credit for the year, or either you or your spouse became bankrupt in the year, or either you and your spouse has elected to split eligible pension income. So now let's talk about credits and benefits. Generally, factual residents are entitled to all federal and provincial credits and benefits, as they would be if they were resident in Canada, and must file a return each year. Deemed residents are entitled to federal credits and benefits. However, since deemed residents are generally not provincial or territorial residents, they are not entitled to credits and benefits from any related provincial or territorial program. There are situations when the child tax benefit is inadvertently interrupted. Generally, the mother is the one whom the benefit is paid because of the female presumption rule. If that person is the spouse of a Canadian Forces member who is a deemed resident and she is a non-resident, benefits may end up being cut off if the CRA is not proactively informed that she is a cohabitating spouse of a deemed resident. Under Section 122.6 of the Income Tax Act, an eligible individual for the child tax benefit includes the cohabitating spouse of a person who is a deemed resident and was resident in Canada in the preceding tax year. Therefore, if the individual who is receiving the benefit becomes a non-resident, please call or write to the CRA advising us that she is a cohabitating spouse of a deemed resident and to continue issuing benefits. Each year, a non-resident spouse is required to submit Form CTB-9, Canada Child Tax Benefit, Statement of Income, to declare their worldwide income, even if it's zero, for benefits calculation purposes. If this form is not received by the CRA, child tax benefit may be suspended. If you or your spouse became a new resident or returned as a resident of Canada in the last 2 years, and you are applying for child tax benefits, you must include Schedule RC66 SCH, Status in Canada Statement of Income, with your application. So here are some references for more information on credits and benefits. These references are also included in the links document provided at the bottom of the webinar page. So the webinar is coming to a close, so we'll be breaking for another minute to allow you to submit your questions or take note on the information we just presented. I'll be back shortly. So let's finish up about talking where you can get more information. So you can contact us by mail at the International and Ottawa Tax Services Office or by telephone. So please note that we also accept collect calls. For information about Quebec provincial tax, go to the Revenue Quebec website. You can also contact Revenue Quebec by telephone. So this is the end of the webinar. We will no longer be accepting questions at this point. If your question wasn't answered during this webinar, please check back as we will try to answer as many questions as possible over the next 24 hours. You will see a link below the slides that allows you to fill out a quick questionnaire about today's webinar. We greatly appreciate any feedback you can give us. So thank you and have a good day.